Hello, and welcome to Thinking Solo, where we talk about ways to succeed in business and in life. I am your host, Ryan Derousseau. I'm a fee-only financial advisor, CFP, enrolled agent, and you can find me at thinkingcapfinancial.com. While I am going to be talking about taxes and retirement and financial things, remember, it's always important to also speak to your own financial advisor and tax professional before making any changes that I'm suggesting here. Today, we're going to talk about something that's particularly unique to the self-employed, and that is what retirement plan should you choose in order to save for retirement. And for those that are just getting started or those who have a pretty sizable business, but it's an individual business, there are two main options, and that is the solo 401k and the SEP IRA. And so today we're going to talk about the similarities and differences. Thank you for being here. Can't wait to get started. All right. So today we're talking about the solo 401k versus the SEP IRA. And when we're doing this, what we're trying to evaluate is what is the best retirement tool for you? Not what is the best retirement tool for everyone. What is the best one for you? Because the difference between what happens when you are an employee is you are just given a tool, but that the company provides because that is best for everyone. Well, you operate as a solo entrepreneur. You get to choose what is best for you, and that gives you a few different options based on the size of your business, how many employees you have, what's your revenues like, what's your profits like. And so today, let's break down two common choices: the solo 401k and the SEP IRA. First, I'm going to talk about the similarities because the similarities are, there's a good amount, but then it's the differences that we're going to really dig into. Let's talk about the similarities first. The big similarities are that both the solo 401k and SEP IRA are in fact retirement accounts that help you put money into a retirement account, and you get a tax advantage by doing so. They both have the ability to put $72,000 a year into that account, up to $72,000. That seems like a lot more than what you would typically hear for your W-2 job or an employee, right? Well, we're going to talk about why that is in a minute, but that's the max contribution. That doesn't mean you have to put $72,000 in order to use these. Of course, if you are putting $10,000 in a year, that is way better than putting nothing in. And so I'm just using the max contributions to give you a sense of how they are alike. It does not discourage the use of either one of them. They can both build wealth and assets long term, so you're able to invest them long term, and they both serve as a deduction vehicle for your business. So we're reducing income, but we're keeping a lot of the money and we're saving long term. So these are all good things, whether you're choosing the solo 401k and the SEP IRA. But let's now talk about the big differences. To get into the differences, let's first talk about how you contribute to each one. So the SEP IRA is a little more simple in that when you are filing your taxes or whatever, you have a certain amount of income that you're creating as profit, and then that profit is being reduced by certain deductions like self-employment tax deduction and stuff like that. And after that, there's a certain number. It's based off of your adjusted gross income and or your modified gross income. And what ends up happening is about 20 to 25% of that number is the amount that you can contribute. So if you pay yourself, let's say after that, all that, $100,000, 25% of that would be $25,000, right? That's the max contribution that you can give in a year. For many people, that is way more than they're going to give. And so for simplistic purpose, like that is an advantage of the SEP, because if you're not going to give way above what your sort of 25% of your profits are going to be, then you're fine, right? Like the SEP is going to cover your needs. Now, what happens on the solo 401k side is there's more flexibility to give a lot more, because essentially when you have a solo 401k, you're broken down into the employee and the employer. And as an employee to a solo 401k, you can provide a max employee contribution. And the max employee contribution for 2026 is $24,500, right? So you can put $24,500 as long as you brought in more than $24,500 to that account. But then as the employer, you are also able to do that same 25% number as the SEP to the employee. This is true of a regular 401k, by the way. It's just the difference is an employer is not going to do that, right? An employer is not going to decide at the end of the year, you know what we're going to do? We're just going to like max out everyone's 401ks as an employer contribution so they can all have $72,000 in there or close to it. But you are the employee and the employer. So in a solo 401k, you're able to do that. And so you take 20 to 25%, depending on which number you're using for the back of the napkin math, but actually speak to your tax advisor for this. And you can put that into your account for tax purposes. It then goes, if you're set up as a traditional contribution, it then goes in tax-free and you'll pay income tax on it years and years down the line when you use some of the money in retirement. And so because of that flexibility, if you are making more in your business, it's almost certain that you're going to want to go towards the solo 401k option just because you have the ability to save more. And that's a really valuable tool to reduce your taxes and also keep more of that money. A big difference between the solo 401k and the SEP IRA is that the solo 401k only operates if you have no employees. Your spouse can be part of this. So you and your spouse can operate a business and both have a solo 401k. But if that's not the case, you can't really use the solo 401k. You have to use something else. And whereas the SEP IRA, there are rules about it, but you can have some employees in there. Now, I'm going to say that with a big caveat, because I will say that a common thing that happens in the solo space, the solo entrepreneur space, is that someone starts running a business and they have a tax advisor, and this tax advisor says, hey, if you open a SEP, you can save this much money on taxes. And the SEP is different in the solo because the SEP can be opened all the way up until tax time, whereas the solo needs to be opened before the end of the year. And so the accountant or tax advisor is always saying, hey, just open up a SEP, put some money into it, and you're good to go. But what happens is maybe that first couple years you don't have an employee or you don't have a 1099 contractor that's helping you, but then you hire one, okay? And you're still funding the SEP. What you don't realize is that after 3 years of that SEP being open, that contractor or employee could very well be eligible for the SEP as well, and you should be contributing to that SEP, because unlike a 401k, the SEP IRA contributions all come from the employer. There is no employee contribution. And so you as the employer have to put the money in the SEP for you, the employee, right? You're the employer, you have to put it in for you, the employee. But if you have other employees, then you also have to put that amount in for the other employees as well. And if you give yourself the max amount, let's say 25%, you have to give every single one of your employees 25% of their wage in that SEP IRA. What happens is people don't realize that they have employees that are eligible for the SEP because they have a 1099 employee. And let's say that 1099 employee makes $3,000 a year, but they've been working with them for 7 years. Well, that person was due a SEP contribution based on that money for the last 4 years, most likely. And so you haven't been contributing it. They do have a growth rate that's involved with that. So you have to go back and actually refill their SEP because you never did it in the first place. If you don't do that, you could find out come retirement that this SEP is ineligible and all the income is actually taxable. And all the money that you'd put in there over the years is actually taxable. And you'd be facing a very big tax penalty and tax bill. And so you have to be very careful if you have employees and you're operating using a SEP IRA. In reality, for both situations, if you have an employee, I'm probably going to encourage you to go to a regular 401k as opposed to keeping a SEP IRA. But the solo 401k, it doesn't matter. You cannot use it if you have an employee. The other difference is just the ability to start the tool. Now, I would say this is pretty minor in general because I think they're both pretty easy to start. But the solo 401k does, as I mentioned, need to start by the end of the calendar year. So by December 31st, it needs to be up and running. The SEP IRA, you have until you file your taxes. If you do an extension, you have until the extension to both create and fund the SEP IRA. So it's it's easier to start than the solo 401k. Also, there's a little bit less documentation required. But those documentations have become so normal from the brokerages that it's actually pretty easy, whether you're doing solo 401k or SEP IRA. So I actually don't look at that as a huge advantage for the SEP IRA, but theoretically it is a little easier from a documentation standpoint as well. The fourth thing to consider is sort of how your business is structured, because in reality, like when you are doing solo 401ks, I actually prefer you to be in an S corp design, because again, you are separating out yourself as employee and employer, and that's kind of essentially what you're doing with the S corp design. And whereas the SEP, it doesn't really matter if it's S corp or sole prop or LLC. It all goes down to how much income you're receiving. So the one caveat is if you are an S corp and you just decide not to pay yourself much of a wage at all, try to avoid Medicare and Social Security taxes, not something I necessarily recommend, but just let's say you do, then it's going to be difficult to get very high savings rates into the SEP because of that 25% limit. It's based on that wage. So if you're only paying yourself $30,000, I don't know what 25% of 30,000 is off the top of my head, but like you can imagine, you can't save very much in that case. Whereas if you are able to pay yourself a wage of 100,000, well, you can still save yourself a good amount. So it depends on what your wage is in that S corp design, but the SEP kind of operates with more structures, a little bit easier, but it doesn't really matter. You can actually use both for all structures. The final thing I would say about the differences, because the difference is really sort of the funding and sort of how it's built and that sort of thing that we talked about. But one is just sort of a mental aspect of it. Like I do find that those who develop a solo 401k tend to stick with it longer than those who develop a SEP IRA. I think oftentimes we have IRAs and we just kind of put money into it when we can, whereas a 401k feels more official, and people tend to, it's sort of the soft sort of observation that I have, that they tend to fund it more consistently and willingly than they do the SEP, whereas the SEP is kind of an afterthought. And, maybe that's just my personal observations, but I feel like that's my experience and my clients. And so sometimes just having the right tool in place that you are treating as like the tool that it is to save for the long term can be very valuable. And so I do find that the solo 401ks does stand out in that way. I hope that sort of explains the difference between a solo 401k and a SEP IRA and helps you sort of determine what tool is right for you. Just in general, and this is very general, what I'm going to say is, as businesses are beginning to operate and whatnot, I'm often putting them as SEP. As soon as they're starting to build significant income, we're moving it over to a solo 401k. You can take a SEP IRA and roll it over into a solo 401k, and so nothing can change on your investing. It's just like you're just moving it from one account to another when you're ready, and you can continue to save that way. You just don't want really both open at the same time, really. But other than that, like it's really easy to move over once you're ready to move to that solo 401k. So generally speaking, once the business gets a little bit more meaty, that's when I'm starting to move to the solo 401k. But I hope that helps as you make your decision as well. Today's movie review is one from a couple years ago. It's a movie that I really love. It's called just Pig is the name. It's from Michael Sarnowski from 2021, and it stars Nick Cage, and he plays a reclusive chef who goes on the hunt for his stolen pig. This pig is a very special pig because it can find truffles in and outside Portland area, and it basically takes him through the underground of the Portland chef scene. But in the meantime, he's, a famed chef. He's like a really, really well-known chef in this area. And he's essentially given up on the act of the business of restaurants, right? Through a loss, he has decided he's rejecting all of that and he's living out in the woods with his pig, collecting truffles and then selling them to restaurants, but he's not actually doing the cooking himself. And meanwhile, as he's winding his way through these chefs, all of which who know him or have been mentored underneath him and whatnot, he starts to provide guidance and advice in a way about life and how we view life and the reasons that we're doing the things that we're doing. And essentially, for not to kind of dumb it down, but essentially, like, why are you cooking? Are you cooking for just a dollar, or are you cooking for the love of it? And in some ways, you can like imagine your own sort of journey as an entrepreneur, because we all do what we do because we have an inkling of enjoyment in helping clients the way that we do, but we can get really lost in the business of it. And it doesn't mean you should become a recluse and go out into the Portland woods by any means, but it's always good as a reminder to why we do these things. And it's really the love and the enjoyment that we get from helping others and seeing their success as our success and that sort of thing, and keeping that in mind as we move forward will really help us prolong our business journey as well. And I think that's an important message. And the pig provides that in a very cool setting and way. That's today's show. You can find me on YouTube at Thinking Solo. I'm on LinkedIn under my name, and you can always find me at thinkingcapfinancial.com. Be sure to subscribe. I will speak to you next time. Thanks for joining. In the meantime, keep grinding.